Please.
Thanks a lot, Fredrik, and all the other team in Oslo. I'm glad to be in Norway, virtually at least. What I will do is I will present a paper based on a paper I've written with Arvind Krishnamurthy from Stanford. It came out in the Brookings Institute, but of course we wrote it already in June. So I've updated it with newer things, and I've put this together in a little book on the COVID crisis. I call it the Resilient Society. And I will also, a lot of figures will be from this this book, hopefully will come out soon. So let me just give you some ideas what I want to talk about. The main topic will be on corporate debt overhang and credit policy. So what the Fed has done, it will be US centric, but it has a global appeal, and it's applicable to other countries as well. The first thing I would like to start out with, how does 2020 compare to 2008? Okay, and I think 2008 and 2020 are very, very different. And what are the differences is that, before the crisis, in 2008, we had this huge buildup of excess housing stock. We had a run-up of credit, and we have very thinly capitalized banks, in particular shadow banks. While in 2020, everything was actually fine. So the corporate debt level was high, and the US government debt level was high because of the corporate tax cut and other things. But otherwise, in the broad, there was no imbalances building up in a big scale as we had in 2008. So it's a very different animal, a different crisis from 2008. And then the trigger of the crisis in 2008 was essentially a revaluation of real estate. And we underestimated the regional correlation across house prices. And then in 2020, we had essentially a lockdown and a shutdown of the economy, which led to some corporate cash flows drying up. So that's a very different animal. And the emphasis was in 2008 very much on the households and the banks' balance sheets. And the corporate sector didn't play such a critical role, while now the corporate sector plays a very, very critical role. Okay, that's at the heart of it. Corporate balance sheets, not household balance sheets or banks' balance sheets. And of course, we have, so the fintech sector played a role, in the sense the shadow banks played a role in 2008. Now the fintech sector might play a role to channel funds to certain small and medium enterprises. And I will talk a lot about how big companies are affected differently from small companies, and how you have to regulatorily treat big companies differently from small companies. What's the similarities we had with structured product CDOs, so credit default CDOs, and we had CLOs, structured products, which are much more about corporate loans. So these CDOs were about structured mortgages, whereas CLOs about structured loans. And the objective of the economic policy is very, very different from the objective of the economic policy in 2008, where the objective was a demand stimulus. So you want to stimulate the economy, while in 2020, it's not about stimulating the demand. You would actually slow down the economy. Why do you want to stimulate it? It's all about securing survival of the firms, okay, of particular firms. And that's where the situation comes in. So it's in the speed in 2008 was very fast, but 2020 was extremely fast in a sense. So the huge financial shock came in March 2020. And just to show you how it affected credit markets, so I will focus here very much on corporate credit. So you see corporate credit spreads. You see that, the blue one, I hope you can see that. You see the distribution of credit spreads across companies, and it's actually very tight. So the blue thing is before the crisis. And then immediately in March 2020, you have the yellow one, you see a wide dispersion. So what you see from the marketplace here, the market was discriminating quite a bit across companies and across industries. Okay, so that's important to take away from that. So there was a huge discrimination. So it seems the markets were discriminating between certain sectors in the economy, saying, oh, these sectors are better, more hit, other sectors are less hit. And then you see, when we go in June 2020, it actually comes back. It doesn't come back to the blue one, but to this greenish one. So the spread narrowed again because of this huge intervention by the Fed in March 2020. So it prevented a huge global meltdown, which, we were very close in March 2020, but it came back. Let me just go briefly to these different sectors. So if you look at revenue change, and that's actually taken from a paper by Robin Greenwood, Iverson, and David Tesmar, just looking at different sectors, how differently certain sectors are hit, and there's always the talk about a K recession. Now, some sectors are benefiting big time, other sectors are suffering big time. Okay, so if you look at arts, entertainment, that's really going down. And then you have others like the tech sector who benefit from this, the revenue is going up. So there's a huge dispersion across the sectors. And one big question is, to what extent is this a permanent shift or a temporary shift? Okay, and that has implications for your policy. If you think it's a permanent shift, then you actually should not prop up the weak parts of the corporate sectors, and you have to focus more on the things which have long-lasting standing power. And so the COVID crisis will come with what I often call a trend accelerator. So we had certain trends in the economy, we had certain trends in the society, and the COVID shock essentially speeded up everything. So everything is now much faster. There was a trend towards home office. There was a trend towards digitalization, but everything was just sped up, and everything happens way faster. And one has to think, which sectors will survive and which sectors will it be a temporary shock. So tourism will probably come back in the long run, but will people behave differently? And there are some elements like, will people still be comfortable using the lift in high rises? So will the whole design of cities change? All of these aspects play a role, and there's this donut effect, essentially. By donut meaning that the centers of the cities will suffer, but outside of the cities they will flourish. So there will be a change in real estate prices, and you see this coming already. So there's some long-lasting effects, and there's some surveys saying that people will be afraid even after COVID about living or taking an elevator or a lift together with others. So that's one big lesson, the first to take into account. And so on top of this trend accelerator, there is also the possibility that the COVID shock actually enables now technological changes which were not possible beforehand because of this QWERTY effect. The QWERTY meaning, if you look at the keyboard, how the keys are aligned to each other, that's based on all technology that these hammers of the old typewriters don't smash into each other. And that's not really relevant, but we are still stuck in the old keyboard design. But this COVID shock is a large enough shock to shock us away from some QWERTY where we're stuck in some local maximum and we cannot go to the global maximum. So that's essentially the long-lasting trend. We will have shifts in that, and that's very hard to identify. It's also hard for policymakers to decide, because typically you don't want the public sector to decide this. It has to be the market to decide that. So what we had is, in March 2020, there was already a huge discrimination across the industries, across firms, which firms were over-levered, which ones were not. And then where the Fed was intervening was essentially providing support to a corporate bond market, and it's just provided a backstop. So it didn't buy many corporate bonds, just said if something goes wrong, we will step in. And that was enough to really elevate the corporate bond market, and it led to actually record issuance of corporate bonds. So this figure here, you see the issuance across corporate bonds across various years. And the last thing here, that's 2020. So, you have high yielding, very risky bonds. There is at record height. So that's this light blue bar. And then you have regular, normal corporate bonds issuing. That's the dark blue one. And you see it's higher than any year before. Okay, so you say, okay, we're in this huge financial crisis, this huge negative shock, but the number of bonds firms can issue is at record height. Of course, there's some element to it. The interest rate came down, the Fed cut the interest rate. So it was the case that actually because of the low interest rate, some firms refinanced their bonds to pay back the high interest bearing bonds in order to buy new ones. But it's really amazing how this played out without the Fed ultimately buying a lot of these bonds, just staying there as a backstop. Okay. Similarly, you can also see this, in the IPO market. I will show you in a minute that there was a lot of issuance of new IPOs. The whole SPAC development, where IPOs at record height. The stock market is at record height. IPOs at record height. The firms can issue. They can ask for funding very, very easily. There's no problem whatsoever. Okay. That was very different. Nobody anticipated. I didn't anticipate that this will work out so radically as we see. And here, this chart essentially shows the interest rate, the differences, the credit spread, it came down very, very much. So the funding costs are much lower now on top of it. Okay, so that's one has to keep this in mind. Now, what I want to say, and what's if you look at firms in general, there are a lot of firms, a large fraction of firms, and that's again taken from this Greenwood et al. Paper. That is New York Stock Exchange, NASDAQ firms who have negative earnings. What's the fraction of firms which have negative earnings? And it's about 20, 30, even 40% of them who have negative earnings. For the large ones, it's smaller, but you can see it's not necessarily the case that the firms do well. There are some weak firms which need to be liquidated, ideally. And the question now is, what should we do in the crisis? Should we just stop liquidating all the firms? Okay. So, and that's saying, okay, one, should we liquidate a firm or should we just ignore liquidation for now? We're in a survival mode, and let's see what's going on. Okay. Now, so let me just look at the liquidation again from this paper again. So if you have distress, what's interesting is once there's distress, you can go into bankruptcy, and there are two types of bankruptcy. You can go into Chapter 11, which means the firm restructure its debt, and then it keeps on going, okay? But the debt holders then become the new equity owners. The equity owners are wiped out. Or you can go to Chapter 7, debt restructuring, which means the firm will be liquidated, so it stops operating, okay? But you can see that if you go to bankruptcy, most of them go into Chapter 7, so traditional bankruptcy, what we have in mind, that leads to liquidation. If you go to Chapter 11, about 15% do that, but then 10% ultimately can actually get reorganized and continue operating. The firm continues operating. Sometimes it doesn't work out. You end up with Chapter 7 after all and liquidate the firm. But what's interesting is that actually a large fraction of them will be handled out of court. Okay, so you don't even go to bankruptcy. You do some debt restructuring already outside of the court, and that's essentially what happens a lot. So a lot of firms just stop operating without going officially to the bankruptcy. So that's if it's the guys who go liquidate and stop operating, only 8.3% really go through a court bankruptcy. 90% actually stop operating without bankruptcy. Okay, and then there's some others. You mostly renegotiate the debt. There's a large fraction where you renegotiate the debt and just keep on operating. You go back to your bank and say, I cannot pay. Can you just forgive some of the debt? Can you restructure it, lower the interest rate, stretch it, and so forth? That's very, very common as well. So there's a lot of flexibility on this side, and it depends on your bankruptcy law in the country. And in Europe, every country has its different bankruptcy law. Some countries have switched to this Chapter 11 and Chapter 7 form. And I will emphasize here now that it's very different between small and large firms. That will be the gist of the talk on the paper I've written with Arvind. Small and large firms are very, very different. And you have to treat them also very differently. So another striking feature is that, of course, in many European countries, bankruptcy was stopped, the moratoria, and hence, if you look at the statistics, the number of bankruptcies went down, and that's not the case in the US. Okay, there's a different philosophy, and I cannot explain really why this is the case. So this is taken a figure from the IMF, the WEO, the World Economic Outlook, which just recently came out, where you see, for different crises, number of bankruptcies always go up tremendously, but this crisis, that's worldwide, the bankruptcy is actually going down. So it's the first crisis where the number of bankruptcies are actually going down. And I said, every year there's a lot of firms negative earnings, and it's very natural. And it's natural of our capitalist system that firms have to be going down, others have to come in. So that's how economy proceeds, how new innovations, new startups drive out old dinosaurs, essentially, in order to keep productivity growth going. And now we have stopped all the bankruptcies, and it's going down. What's striking to me, and I don't have a good explanation for that, that's taken from a Bloomberg article. If you count the bankruptcies in the United States, in the US, bankruptcies went up. Okay, so there are famous cases like Markus and so forth. Many of these retail chains went bankrupt, but in the US, it seems to be different from the rest of the world. It might be a regulatory difference, but that also means a different philosophy. Essentially, do you want to restructure the economy now or just put everything on hold and stop all bankruptcies? It also means you might have 1.5 years or whatever, how long the COVID crisis lasts. You don't have any restructuring going on, no constant cleaning of the system for the more new productive firms to squeeze out the old, less productive firms. I should also say that, so what I want to focus on, I should also say it's also in the easy way to issue now new bonds. That makes, of course, bankruptcy much less likely because now these firms, everybody can issue bonds. And we have seen from GameStop and others, it's very, very easy to issue at these market conditions, get new funding. And that makes, of course, bankruptcy less likely. And there's some, other work, which I think it depends very much if you issue new bonds, what you do with it. If you issue it to sustain your company, to expand and invest, to create new jobs, that's good. But if you just use it to pay out dividends and lever up your company because the interest rate is so low, that's not good for society. And Martin Schmalz, who is, I think, with you guys in Oslo, has a recent paper on that, on this issue. So let me just highlight the difference between small and medium enterprise and large firms. And I will come back to this. And the small firms are relying much more on bank funding, while the large firms rely on the corporate bond market. So typically, the central banks in the US, so Fed in the United States, has much more ability to control the financial markets and less ability to really go through the banks to help small and medium enterprises. Okay, and you can see that typically it is the case. So what I've plotted here is the credit spread. It's the funding costs corporate bonds have. So if you want to, as a big company, issue some corporate bonds, what extra funding costs you have? You can see the 2008 crisis, it spikes. So the dark blue one. And then I have plotted also the loan officer survey. So the Fed is conducting loan officers in the banks saying, how tight are you in giving new loans? And typically, it goes hand in hand. So small firms go mostly to banks, and the loan officer decides, we give you a loan or we don't give you a loan. And the large companies, they can go to the corporate bond market, and then the corporate bond market, a certain yield is. And typically this goes hand in hand. Whenever the credit conditions tighten, it tightens for small firms going to the banks, and tightens also for large banks, large firms going to the corporate bond market. What you see here this time around, it didn't tighten much for large firms because the yields didn't go up, and they went up only in March and then came down a lot. But for the small firms, the banks became much more restrictive to give loans. Okay, so it just jumped almost like in 2008, but it also came down. But it's a way sharper spike for small firms than for large firms. And I would like to zoom in on this distinction between small and large firms, and that's what the center message of this paper is, which we wrote for Brookings in June. And of course, the tension is always, when you do some policy, how much you want to avoid some bankruptcy cost. So that's one thing. So inefficient liquidation, the scarring effects. We have to close down some restaurants now. They would have been available restaurant, but because of COVID, it will be closed down. And this restaurant will never, there will be some bankruptcy costs, they will never come back. On the other hand, you might have some zombification. If you're too generous, you might drag on inefficient companies, and they're just crowd out then the young ones, rather than the other way around, which the young new startups which are productive should crowd out some old dinosaurs. Okay, and that's essentially the scarring. On the one hand, you want to avoid that in both directions, and that's quite a delicate balance in how you should do it. The message of this paper is that what you should do depends very much on the size of the company. And just to give you the punchline, depends very much whether the company can do Chapter 11 or has to go through Chapter 7 right away. Okay, and that's very different. Small companies always have to go for Chapter 7. There's almost no way to go through Chapter 11 because it's very difficult. And I will highlight why. And that's essentially what we do. And then, of course, in the US, it's a very US focused here that QE was undertaken in order to bring the corporate bonds yield down. They have this Main Street lending facility, which was intentionally designed for small and medium enterprises. And you also have the Paycheck Protection Program, but I won't go into the details of these programs. So if you, for example, if you have, so let's look at the policy question. If you have an extra dollar or an extra euro and you can invest it, and what would you do? So first, in a world where there are no frictions, then we have our famous Modigliani-Miller theorem holding. And so credit policy, you know, it doesn't really matter whom you give it to. You know, the only part of the policy that matters is the economic outcome. And so given $1 to a firm, has no impact on the real operation of the firm, okay? Because credit frictions are not there, everything operates perfectly. You just give $1 and then they either pay it out or they invest it, but they invest the same degree, the firms invest in the same degree as they would have invested beforehand. And the firms just take subsidies and pay it out in form of dividends to the shareholders, okay? Now, of course, we don't live in this stylized world, but just a benchmark. So now let's suppose we live in a world with frictions, and we would like to focus on two types of frictions and just highlight how different they are between large corporations and small, medium enterprises. So what's a distinguishing feature between the two? What we're distinguishing is a large corporation is one where the management runs the company, but is not really the equity owner. And small firms are where it's run by the owner himself, okay, or herself. Okay, that's the owner runs it. There's some liquidity constraint the owner might face. He has to pay the debt service on this, and you know, if he can't, he will be subject to Chapter 11. On the other hand, if you think about big companies like airlines in the United States, they go through Chapter 11 all the time. What happens is that the equity owners shareholders will be wiped out. The debt holders become new equity owners, but essentially the management might even stay the same. The guys who run the firms, the CEO stays the same, and nothing much happens on the operation side. So it's just managing the liability side of the balance sheet. That's what Chapter 11 does. But it has no real implications on essentially the operation of the company. It is all about managing the liability side of the balance sheet. And so depending which of the two firms you fall in, but of course it's not black and white in the real world. You might be more a large corporation and less a small or medium enterprise. But I think that's the decisive thing. And if you have limited number of funds where you want to spend it, we would argue that, you know, a general broad brush approach, which also helps certain shareholders, might not be the right thing to do. So you should focus on the small and medium enterprises, because here the frictions are much, much larger. And let me just explain. And actually, subsidies for large corporations might make things even worse. Okay, but that's the message. So let me focus on the large corporations. Now I want to focus on this debt overhang problem, a la Myers 1977. So the management-run firms, they have potentially they are underwater, so they have deep-pocketed outside equities. So that's the idea. So it's help as some wealthy shareholders, or not so wealthy, but essentially shareholders you can wipe out. And the expenditures, labor, and capital to maintain the enterprise value. So you have to keep the operation running in order to run it. And there will be some, because of the debt overhang problem, there will be some underinvestment, which erodes the enterprise value in the long run. So there will be just here a picture. If I have the enterprise value on the x-axis, that's the payoff of the debt contract. So that's the face value of the thing. So if the cash flow generated, or the future cash flows, real value, discounted value is higher than that, you can pay off all the face value. If you, in this area, you go bankrupt because you cannot, the fully promised face value, you cannot fully pay. But that's essentially this hockey stick of a debt contract. Okay. What do the equity owners get? They're essentially the equity owners. They're getting essentially the leftover. That's to the equity owners, and that's what's plotted here. Okay, that's keep in mind. So the important message looking at this figure is that the equity owners, as long as the firm goes bankrupt, ultimately they don't get anything. Okay, they only get something if the firm, they're supposed to shock down the road, and then they get the upside. Okay, but there's no downside. they just get the upside. Okay, and it's a call option feature, so that's 0, and then you get this hockey stick call option feature. Now, what's the incentive for an equity owner? Equity owner, let's suppose we have the value here and it moves around. There's a stochastic process moving around. He would like to keep this going because there's some possibility that you get lucky and come to this region here, and then something is worthwhile to replace. So he would like to keep this option running as long as possible. So he keeps on going. This company is already worthless. It's not doing much, but there's a possibility it might get some positive shock. And this option value he wants to keep as long as possible. That's based on the Leland model and the dynamic model. That's how the situation works. So you keep the option, and that's what the equity holders would like to do. So so what you do is you run this company, and it's not about inventing new things or improving society. It's essentially, so I'm jumping perhaps a little bit back and forth. It's essentially about keeping this option value as long as possible alive. So you switch your mechanism, your mentality in the company changes, and the equity owners would like the CEO to just pay off the debt. By paying the interest, you can keep, by avoiding bankruptcy, by paying interest, you can keep the company running all the time. So you just focus on debt servicing. So rather than focusing on inventing new things, going in new areas, keeping the workforce, you scale everything back and you pay your debt service in order to maintain the option value. Okay, that something positive might happen, and then you have the option value, and that leads to some strategic delay. Okay, so you underinvest, the enterprise value erodes over time, but you delay it because it increases the option value, and this increase in the option value, that's what the equity holders want. But that's not really what society wants. Society would like to have, why should we keep this company? We shut it down, and then the resources will be free, and then it can be devoted to some other companies in particular. Or if given this debt overhang problem, you would like to restructure the debt overhang problem. You wipe out these equity owners, and then given that they are wiped out, then they have an incentive to keep investing and keep the jobs and don't lay off people, not just keeping the shell firm essentially with the option value running. And that's the idea of Chapter 11. So if there are no bankruptcy costs, so let's suppose in a world where there are no bankruptcy costs, with 0 bankruptcy costs in Chapter 11, what you would do is you wipe out these equity holders. They're just delaying the restructuring of Chapter 11. You just want to, restructure as soon as possible. And then once they're restructured, they have better incentives to focus on creating new products, to focus on keeping the workforce, and so forth. Okay. Now, if you have positive bankruptcy costs, and then it's a little bit of a question: how long will the COVID crisis last? How viable is the business down the road? Okay, because the bankruptcy costs are social costs. So let's suppose you just spend a ton of money on lawyers, and that will be just socially, a lot of effort has to go in order to do the bankruptcy. Then you have to take these bankruptcy costs into account. But I'm not sure how big these bankruptcy costs are relative to this delay costs. Okay. So let me just, I jumped here a slide. What you do eventually, the firm will file a bankruptcy, and you probably could have done this Chapter 11. So filing Chapter 11 to eliminate the banco debt overhang problem. And when you eliminate this banco debt overhang problem, but then the firm's orientation and not just focus on debt servicing in order to keep the firm artificially alive, to keep the option value alive, but really focusing on producing something meaningful for society. And so there's, compared to the first best, if you switch off the bankruptcy costs again, compared to the first best, with the 0 bankruptcy setting, there's way much to delay by the equity holders. The equity holders have way too much incentive to underinvest and delay the bankruptcy as much as possible. Except if you really think this social bankruptcy costs are very high, and you would like to have these bankruptcy costs, then it's different. But that's unreasonable to assume that. Now, when you do some credit subsidies, and here again, it's not focused on the Norwegian model because I'm less familiar what Norway did. So can you subsidize credit? Now, what happens in this world, if you subsidize credit, it just makes it cheaper for the equity owners to delay it even further, because the only problem they're having is essentially to service the debt in order to keep the firm alive, to keep the option value of the firm. Okay. And so essentially lowering the credit cost of credit, lowering the interest rate, and lowering other costs of debt services just keeps the zombie firms longer alive. Okay. And then it depends a little bit if you have bankruptcy costs. So if the bankruptcy, that's what I said, zero bankruptcy costs or low bankruptcy costs. And if there's a long pandemic, you would just restructure right away. That's the right thing to do. Except if you have high bankruptcy costs, let's suppose the bankruptcy costs are huge because it's the restructuring procedure, bankruptcy law is not really working well. You destroy part of the social value of this huge parts when you just restructure the liability side. Now, we don't change the company, the operation of the company, you just restructure the liability side, but suppose you cannot do it. And it's a short recession, then you don't want to do it. Okay, then the strategic delay is a good thing because the social planner would also like to do this strategic delay. But you can see the tension. The equity owners decide on filing for bankruptcy purely based on some equity call option feature, and also would like to gamble a little bit, going to more risk, while the society or the social planner would make a decision based on how high are the bankruptcy costs and how long will the recession be. Of course, if there's uncertainty about the length of the recession, then you might be in this one of the two worlds. You have to take this into account as well, and you have to take into account that a bankruptcy is an irreversible cost. Okay, so if you have long, high bankruptcy costs, you do a bankruptcy, you cannot undo it very easily. So that's another consideration you have to put into the game. Now, this is for the large corporations where Chapter 11 ideally works well. The main message is, if the bankruptcy costs are low, and by bankruptcy costs, just the cost of restructuring the debt, not restructuring the firm, the operation of the firm, but then the equity holders wait for too long. It happens way too late. And it should actually happen earlier. And society should not make it cheaper for them to delay it even further. Now, if you have, on the other hand, an SME, that's a case number 2. So if you have an SME, then it's actually different. It's an owner management firm. So the owner really puts his own private wealth in, and it's his management really makes a difference. So if you restructure that he has an equity stake in the firm is really crucial in order to avoid some moral hazard problems. And he has his personal assets in the firm. His personal assets serve as a collateral for the loan he gets and so forth. If this is a firm, if this is what matters, then it's very, very different. So if there's no Chapter 11, if you wipe out his equity stake in this firm, nobody else can really do it as well. So in small firms, you run your own restaurant, you have, in some retail shops in downtown, somewhere in Oslo or so forth, you cannot just replace him with some other guy. It has to be somebody who has some equity stake in it. If you have to replace him, it has to be somebody else who has an equity stake and the expertise to run this particular business. Okay, and that will lead to scarring effects. So here it's very different. So here, if you now reduce this guy's funding costs, he might be able to hold on longer to that, and we can avoid this Chapter 7 bankruptcy. So Chapter 11 is not an option for that, because you really need his stake in the company in order for the company to operate. And that makes it very, very different. So here for these types of firms, if you don't help them, they will scale down. And by helping the firms with lower funding costs, you help them to maintain the firm and the scale up. And the other thing is, if you don't help them, they will also scale up very slowly. So after the crisis, after the COVID crisis is over, if you have eroded the equity, it will take a while through the return earnings for them to come back. And having not been helping them might also mean you bounce back at a much slower pace. Okay, that's for that firms, actually, it is way important. So the subsidies is actually very beneficial because you don't have this Chapter 11 feature, which leads to strategic delay. For these firms, that's what you have to do, is ideally to do. And it's very similar, actually, that's for these small firms. It's a little bit similar to what we had in 2008 recession, where we had these households with marginal propensity to consume, with a high marginal propensity to consume. We said we have to help their balance sheets. They're underwater. They have bought a house, and if they sell the house, half of the house will be destroyed in value, the whole neighborhood will suffer from that. And that's will be similar for the small and medium enterprises. So it's a very different world. Okay, so if you look at the firms, so what we look in this section C is that what has credit policy done so far? And, you know, I've shown already in the initial graphs, and I know I'm going way over my time. Sorry for that. You can see that, you know, if you look at the price of risk went up a lot in March. That's just from this paper by Haddad, Morera, and Moore. They show essentially, it's another interesting thing, focusing really on March 2020. So the price of credit, the price of risk went up a lot, but the default risk didn't go up a lot. But that's, you know, just zooming in on March 2020 on this. So let me perhaps jump to the conclusion, given that I'm running over time. So what the summary essentially is, this recession is different. So typically in our economy to function well, we have some creative destruction going on. Means inefficient firms have to be closed down to make place for more efficient firms. And that's very, very important in the general operation of our economy to stay on top of it. It's also a matter of fairness that inefficient firms are closed down and more efficient ones have a chance to grow into this space. And so that's what we typically have. This recession is now very different. So it's not about creative destruction because we have this huge shock and it's a temporary imposed slowdown of the economy, and it might hit different sectors very differently. And we have to make a judgment call which sectors will be surviving in the long run or will grow back or even stronger, and which ones will not. And that's a little bit tricky because policymakers have to make some judgment call. And that makes them subject to lobbying, and political influence will play a role. So we don't want to really have that. That's really very tricky. And that can lead to some scarring effects, and one should really minimize the scarring effects. The Fed was very much oriented towards lowering the costs of debt, and that actually might be harmful for firms which should be having a debt restructuring. So even if you think the firm itself, the operation is good, but it's just is over-levered, so you want to just restructure the liability side of this firm, and the equity holders who have to file for this bankruptcy, they always strategically delay it. Okay, and there's too much delay, and with this lower funding costs, they will delay it even further. And that leads to this debt overhang problem, the zombification aspects, which means the equity holders have an incentive just to purely service the debt, which is now cheaper to service, but don't invest in new technology, don't hold the workforce high and so forth. While for SMEs is very different because you really need the owner run equity in the company in order to have the right incentives to do the right things. So let me leave it at that and open for the Q&A. Sorry for running over.
Absolutely no problem. It was such a pleasure to listen to your talk, Markus, so I didn't want to interrupt you. I think it was really, really interesting. I hope we have time for a few questions. Good. So you can please just raise your hand, and I will unmute you first. Charlotte Østergaard, you can unmute yourself now. Then we have Espen Moen, please. Charlotte, short question.
Hi, Markus. Thanks for a great and very interesting talk. So I was wondering about your argument for the large companies. So it wasn't clear to me whether you sort of had in mind companies that enter the pandemic with a debt overhang problem, or whether you're thinking about companies where the debt overhang problem is a product of the pandemic. So in the latter case, would you still want to wipe out, is your argument that you still want to wipe out the equity holders because otherwise, given that you're now in a pandemic with an overhang problem, you can't, there's no way sort of out of that situation? Was that your argument? Or did you have in mind predominantly large companies that entered the pandemic with a debt overhang problem?
So definitely the ones which enter with a debt overhang anyways, but also the ones which have a debt overhang problem because of COVID. So it depends a little bit on how wealthy the government is. Now, if you have a very wealthy government, they can afford to bail out their shareholders. But typically, I would say it's not the role of the government to ensure wealthy shareholders in a sense. And that's just so if the objective is to keep the economy running, to make sure you don't want a debt overhang problem in any case, so you can do two ways. You can either wipe out the existing shareholders, or you just give them enough wealth such that they have the right incentives again to get around of this undercapitalization, to get rid of this debt overhang problem. Just give them, but that's a big gift to give away. And that's a little bit of a question for society, whether society can afford this and whether you want to redistribute wealth then to the wealthy ones. We were shocked by a COVID shock, and we helped them to overcome that. Does this answer your question?
Sorry, thanks. I'm done.
Thanks.
Thank you. Then Espen Moen, and after Espen, Morten, and after Morten, I have Gisle and Kjetil.
Yes, thank you very much, Markus. This was very interesting. It was, and also I think sort of what you said is many economists in Norway have expressed similar views in the national press. So, and actually, you did to some extent answer my question in your previous answer, but still, so in Norway we have this system that the government is giving cash to the firms, not subsidized loans. They do that as well, but in addition, they give cash. And to big firms as well as small firms. Maybe the big firms, they get slightly less, but still they also get. So, and most of us, most economists have argued strongly that, including me, argued strongly that it's not such a good idea to give these big funds to give big subsidies to the big firms. But if you look at your argument about the debt overhang problem, and if you think that, if you want to see if it's possible to understand sort of the Norwegian politics, in a country which is relatively rich, where government is rich, like in Norway, and if you think that maybe the cost of bankruptcy is relatively big, relative at least compared with the US, could it be that you could get around the debt overhang problem by giving so much that they get out of the problem? Just like giving, as you said, a big gift. That seems to me to be sort of a very, very costly way of doing it, and therefore, and sort of the income distribution effects would probably not be very good. But is that something that you can you think of situations where that would be a good idea? And have you seen other places in the world where they are following a policy like that to give cash transfers to the also big firms in order for them to get out of the debt overhang problem? That was my question.
Yes, so essentially for the small and medium enterprises, it's better to give them grants than loans. So loans really don't help the debt overhang problem, only partially help. So if you give them subsidized loans, essentially it has a grant component to it because it's a subsidy, and this way, but the debt overhang problem you don't get really rid of. Grants really help it, but it's a redistributional thing. You could take it away from the taxpayer and give it to a particular, and you might say that was such an extraordinary shock. I have to help out certain smaller enterprises because that's, also for cohesion of society, I have to do that. And grants typically are better to avoid the debt overhang problem. So many people criticize the many loans we give or the governments give creates a huge debt overhang problem, and that just creates problems down the road because it distorts incentives to invest and keep everything productive. For large firms, it's purely a redistribution. It's a question: do you want to redistribute wealth from the taxpayers to the shareholders? And I don't know how good the bankruptcy code works in Norway, so I'm not familiar well with the Norwegian situation. I know the German situation. Germany is paying, especially for small, 70% of the lost revenue is compensated for restaurant owners and dentists and so forth, which I think is a fair thing because it makes sure that the small companies stay alive. For large companies, somebody in the society has to bear the losses. The question, whom you push the losses to? Do you want to push it to the regular taxpayer? If the tax rate is very progressive, you might say, okay, that's fine because the wealthy pay anyway, and the shareholder holdings is also very progressive, then it might be okay. So I don't know the details in Norway, but it also depends how much you care about wealth inequality and aspects like this. So it's more an inequality consideration rather than an efficiency consideration if your Chapter 11 procedure works well.
Okay, thank you. In the interest of time, can you have very short questions? I think first, Morten Grinaker at BI, please.
Thank you so much for a very good presentation and a very interesting paper. So my question regards how to think about this social cost or these scarring effects of bankruptcies. So the context for my question is that I have a paper with Andreas Kostøl on where we estimate how costly corporate bankruptcies are for the workers of these firms using judge-fixed effects. And we find persistent and substantial earnings loss for these workers and lower probability of employment. But my question is, to what extent we should think of these income losses as a social cost of bankruptcy or not? So it might be that these workers are compensated for working in a risky firm prior to the bankruptcy. But on the other hand, it might be that the government will have to pay out a lot in unemployment insurance in order to support these workers. So should I only think of these losses as social costs to the extent that they reflect the loss of match-specific surplus, for instance? Do you have any views on this?
Yes, I think you should take this cost for the workers as social costs into account as well. But if you go purely for a Chapter 11 restructuring, the operation of the firm is not changing. So it's to the extent you can keep the operation going. Of course, in the real world, when you do Chapter 11, there will be pension claims are wiped out too, and workers suffer from that too. So it's not only the equity owners. And I guess you want to take this into account as well as a social cost. You don't only hit wealthy equity owners, depending how you do the restructuring. So it depends very much on the local bankruptcy code, how much you can hit only the shareholders and not touch essentially the workers. But I agree. I mean, it has to be that you take the social aspects into account, and to some extent, you want to nudge when you do that as a policymaker. You want to take into account your perception, at least. I know it's politically very dangerous, which industries will do well and will actually be boosted down the road, and which industries might be anyway on the way down. It just was a trend accelerator. The COVID shock was a trend accelerator, and that just makes the restructuring faster, and you don't want to prevent and slow it down again. But this is, of course, a very tricky thing, because then policymakers decide which industries will grow and which ones will shrink. And then, as I mentioned earlier, there's this huge lobbying effort, and depending who is employed there and how quick you make the transition. There's also an argument. You want to not have a transition too fast, because people have invested in human capital in this particular industry, and if you slow it down, they can retire and phase out very easily, while otherwise they can't. If it just the whole industry is gone and all the workers are suddenly unemployed, and that costs additional social costs. And this bankruptcy cost of this form you want to take into account as well.
Thank you. Now we have a very short question from Gisle, and then after that, a very short question from Kjetil. If you have time, Markus, we're a little bit on overtime.
Yeah, we can do it a little bit longer, no problem.
Okay, thank you.
Yeah, you have to tell us if you run out of time, Markus. I have a very short question. Is there any? You talked about these zombification costs of debt overhang. Are there any estimates out there about how big those costs are? I didn't see that in your talk, about how the number. How big is this effect?
So I haven't done any study by myself. So I think Viral Acharya and others have done some work on the cost of zombification. I cannot quote you. So that would be, I agree, it's a first order policy question. One has to figure out how big the costs are. We know from the Japanese experience some of the costs, but I can't quote you any numbers. But I agree, if I were a policymaker, I would immediately tell my staff, let's quantify these effects.
Kjetil, you have a short question, and then Martin Schmaltz.
Very pragmatic question. So, according to you, and I think most economists agree, we don't need to help the big firms, financial markets take care of them. What we like to do is to help the small and medium size, and in particular, we like to help those that are in sectors or industry that are hard hit. problem, and you just said it yourself, the problem is that the moment you try to do that, the lawyers enter the room. And they enter the room, or the Minister of Finance, because anything has to be, you cannot write a law based on the industry where you first registered. The first time you registered, you might have started as a hairdresser, and later you've been selling IT equipment. I don't know. So how would you imagine you want to do? Minister of Finance insists on anything they do has to be somehow simple and something that can apply to everyone. How would you do it in order to get it to the people who need it?
That's a tough question. So it depends very much on institutional details in each country. You know, for me, it's very hard to say anything about Norway in this regard because I don't know the institutional details.
How do you do it in Germany?
I mean, in Germany, you know, everyone is registered as a hairdresser. I mean, they're still very well, you know, you're part of a guild almost. I mean, the guild is not there, but it still exists to some extent. So you can actually dip into this information. But I find it also problematic because at the end of the day, you have a lobbying going on. The group which has better lobbying power essentially gets more money. So you have to be careful about that in particular. And I think then it's probably, on the other hand, if you're not so wealthy, you cannot just distribute everything broad brush to all of the sectors. And then, so you have to conserve some money. So you have to find the right balance. I'm not sure I'm answering your question. But let me just say perhaps I can bring up a new point. I take a few minutes of this. I'll be going a little bit longer if you don't mind. The fact that the US paid out all the stimulus checks, I mean, they're not allowed to be called stimulus anymore because there should be stimulus checks without stimulating the economy. That actually helped a lot the wealthy as well. So let me just give you an example. If you get a stimulus check, I can still pay off my rent. Without a stimulus check, I would default on my rent. So the landlord is ultimately benefiting from the stimulus check. Okay. Similarly, if you have credit card receivables, so you have an asset with credit card receivables, the credit card default rates are at minimum right now because people cannot spend on going to restaurants and other things, but also of the stimulus checks. So when you do stimulate, or if you distribute funds, as you said, you give it to some party, but who is the beneficiary is not really clear because it affects the whole chain afterwards. So in the US, it's very striking that real estate prices kept so stable and the rents kept fairly stable, and credit card receivables actually seem very safe now, is primarily because of the stimulus payment. And there's a lot of liquid wealth out there now in the US, and that makes these assets much less liquid. And the guy who holds credit card receivables is actually the beneficiary from that. And that might argue later on, okay, you know, who has to pay? At some point, we have to levy taxes on somebody to pay back all this money which we are distributing now. You have to look at who was actually the ultimate beneficiary from the stimulus money, and that makes of course your question even more tougher. It's not just the direct subsidy; it's also who is ultimately the beneficiary. You know, it depends, and that depends very much on the bankruptcy law. If you have a very smooth bankruptcy law, or you have a way to ensure that you don't pay your rents for 2 months, it's not really the restaurant owner which suffers, it is the owner of the restaurant building. And how this trickles through makes the analysis even more challenging. And right now, there's such a speed with which we have to decide this. Probably you can't take all of this into account, but you have to keep in the back of your head that this is going on too.
Thank you. I think we have, do we have time for a last question, Markus, from Martin Schmaltz, please, Martin.
Thanks, Markus. So it strikes me that some of the debt overhang problem we now face in debate is a bit self-made and existed before the coronavirus hit. So, and I'm worried that we're now in danger of distorting the economy in the same way further, and instead of getting rid of the problem. So how did we create the problem? So we subsidize debt with tax-deductible interest, right? And I don't think we have a good rationale for that, or at least I'm not aware. And those companies that made most use of the tax subsidy, for example, by debt financing payouts to shareholders, are now those that are first in line for grants and tax subsidies in the corona crisis, right? So even in the summer of 2020, so after the virus hit, And a lot of large and private equity-backed firms issued more debt at artificially low rates to make more payouts to shareholders. And I say artificially low because of the Fed backstop and willingness to buy high-yield corporate debt. So all of that favors large firms, which are at the same time those that need the least help because of Chapter 11 and other reasons. So we subsidize high debt levels and therefore fragility with the tax code and with central bank policies, which seems to make the firms less resilient to crisis, including the COVID crisis. So I think our ex-post policy should also take these distortions favoring debt into account and not exacerbate them further and encourage this moral hazard problem further. And I just wondered if you agreed with that and had comments on that. Like, it seems like everybody knows about the tax subsidy of debt, but nobody does anything about it. So why is that? What are the impediments to countries getting rid of the tax deductibility interest, or have some countries tried? I don't know about that. Thank you.
Yes, hi, Martin. So I totally agree. So let me just, I actually pushed in that direction. So I even proposed to the Fed there should only include in the bond purchasing programs bonds of firms which have not increased the dividend payments or payouts. Okay, so that would have immediately led to a spread of firms. If you increase your dividend or make a stock repurchase, you're not eligible anymore for the Fed repurchasing program. That would have immediately led to a spread widening, and firms would be scared to pay extra dividends. I think it's a scandal, in my view, that firms issue a lot of debt and then buy back stocks to lever up because it's so cheap now. And this will just create financial instability problems down the road. So, and I mean, zombification and debt overhang problems, but also if the interest rate ever were to go up, we have a lot of problems in our hands as well. So that's why, even if it's, the Fed is only buying the secondary market, and that was the argument, we only buy in the secondary market, but I would have done it this way and I would have been very reluctant. Same thing for banks. I would not allow them to pay any dividends at this stage. So I would just conserve as much equity as possible. You can see that that's one way to go. More generally, why is our tax code this way, that we subsidize debt over equity financing? That's, 99% of the economists agree that's just crazy that we subsidize debt financing, while equity financing is so much better for society. And, in Germany, we had, before 97 or something like that, or 98, we had a tax code where, there was a equal balance between that, because if you paid out dividends, you got actually a credit from the corporate tax the corporation paid, so there was no double taxation. So what they did actually at that time, they said, okay, let's introduce the double taxation on equity financing. Let's introduce it, but lower the tax rate. But now I have distortion between debt and equity financing. And that's actually a bad thing to that. And we should actually have, besides our international tax harmonization and some coordination of taxing for the big techs and other firms, I think it's important to get rid of this double taxation. But it's politically, not on the agenda, and it's probably also not very popular, but I think it would be important for stability reasons. But it's not so easy to communicate because it's not visible right away.
Thank you. I see that there have been 3 questions in the Q&A. I haven't been good at following that. Can I just mention that briefly to you, Markus?
Yeah, we can do 3 questions.
Thanks. So first, are firms with negative earnings necessarily doing badly? And then what about taking over large companies in selected industries, as we did with the banking sector in Norway in the early 90s, I guess? And also, lastly, how would optimal policy be for large firms if there are no Chapter 11 possibilities and they have to go through the same process as smaller firms?
So hold on, what was the first question again? Sorry.
The
first question was?
The first question was, are firms with negative earnings necessarily doing badly?
No, actually, so it could be that you have 1 or 2 bad years, or it could be that you're in an early phase in a startup, you have negative earnings. So I'm not saying negative earnings are bad signs. It's just the figure I've shown was more an illustration that, you know, it's a little bit shocking when you see this figure that 30–40% of the firms have negative earnings. And I'm not saying all of them should be closed down. No, it's like, it just shows how vibrant, how much change there is. But negative earnings should be part of it. And it's also a sign that of risk taking. And we would like the corporate sector to take some risk and invest and, you know, do especially R&D investment and push the frontier. That's as a sign of negative earnings. So I'm very much in favor of keeping this open. So I'm not for a zero risk world. For the second question about the takeover of large banks or firms, it depends. So if you have a sector which is critical in your country and, you know, creates a lot of externalities to society as well, and, you know, if you shut down the banking sector, and the banking sector is critical for many things, but electricity companies and other things are also critical, and they're undercapitalized and they do non-optimal things purely because they're undercapitalized, you would like to recapitalize them, but then also take some ownership stake as a government. And then later on, once, so you have to, instead of the firms themselves maximize their own profits, their own objective, or the shareholders' objective, society's objective might be different. It might also be the case in a world where you have global competition and other companies, other countries subsidize certain firms. You might also feel like, even though I'm not favoring, so I like fair playing field for everybody, if other countries where you're competing with do something, you might be forced to do as well something. But that's, of course, not healthy in the global scale. Now, for the last question about Chapter 11, I think so what's interesting is that, let me first go, so for small firms, Chapter 11 was not really working in the United States. And it happened to be that the US has introduced the Chapter 11 for small firms, which became ineffective in February 2020. So it just was a coincidence. But it was not really picked up. This new regulation was not really picked up because it doesn't work so well for small firms. Essentially, what I would argue, it's an opportunity for the European Union to harmonize some of the bankruptcy rules across Europe, because we all face the same problems. It's not a German, French, or Norwegian, or whatever problem. We want just an efficient bankruptcy regulation and introduce in Chapter 11 across Europe as a whole. But if it's not there, if you cannot just work on the liability side, but whenever you have to shut down the whole company, then the whole argument goes away. Then you have to subsidize. You know, then you keep the firms alive at this stage. Except if you think it's in an industry which is on its way out anyway, then you speed up the thing, but otherwise you just keep them alive.
Great, thanks. Thank you so much, Markus, for coming and sharing your ideas with us. It's been a fantastic lecture and a stimulating discussion afterwards. So thank you so much, and thank you all to all the participants and attendances for coming to the webinar. And stay safe, everyone, and thank you for coming.
Thanks to everybody. Thanks for coming. Bye-bye.
Thank you, Markus.
Thanks.
Thanks.
It was a great webinar. Have you stopped recording, Fredrik?
Stop recording now.
Okay,
that's good.